So hello all my dear students from South India. I hope you all are doing good and your studies are going great for your upcoming November 2023 exams. So today here we come for you all in full English for discussion on one of the most difficult RTPs that ICI has ever put up for a CA final exams, indirect tax, that is RTP of November 2023. Now this RTP contains some excellent MCQs, some excellent case scenarios, topics which are generally left out by the students, but ICI has especially targeted those topics over here. Okay, so my objective over here is to, I have already discussed this in Hindi, so my objective is to again discuss this in full English for my dearest South Indian students. I have been doing this for the last 1 year, that whatever I generally do for my North Indian students, that is in Hindi, I generally also cover up that in full English as well. Okay, now be it your MCQ videos, be it your revision videos, be it your RTPs, MTPs, or whether we are talking about the compilation of past papers, past RTPs, past MTPs, which I have done for the last attempt students. So I have done it for both the language, that is also for my dearest students from South India. So anyways, without wasting any further time, let us start with the first case scenario. Now the first case scenario, the objective over here of mine would be not to read the entire case scenario. That is something which you are going to do at your end. My objective over here is to explain the reasoning of each and every MCQ to you all. That what is the reason for this answer for this MCQ. That is something which is my objective over here. Okay. Now, the very first thing which I would like to say in this case scenario is, this case scenario generally covers three aspects. It covers survey. Secondly, survey which is covered under 133A. Second, it covers collection of information which is covered under 133B. And third, it covers search and seizure which is covered under section 132. So these are the three aspects which are covered over here. Okay. So let us start without wasting any further time. The first question over here is, let me read the question. The first case scenario, is the action of the AO entering the premises of A Limited at 9 p.m. and continuing survey operations till 11 p.m. valid? So first of all, is the action of the AO valid? AO is entering at 9 p.m. Now listen carefully. If AO is entering at business premises, okay, and if your business hours is in night, if the business hours is in night, generally AO should enter any place after sunrise but before sunset. But in case of business, if your business hours is in night, then he can also enter in the night also. Now what is your business hours? As you can see over here, the business hours of A Limited is, you can see over here, it is 10 a.m. to 10 p.m. This is the business hours and it is all 7 days, every day. So AO is entering well within this time. Therefore, it is valid for AO to enter at 9 p.m. and he can continue the operations in the entire night also, because the time limit is of entering, not of exit. So if the business hours is of 10 a.m. to 10 p.m., AO can enter any time before 10 p.m. Yes, when can he exit? That is his choice. Whenever he wants to exit, he can exit at his will. You cannot say him that you should exit at 10 p.m. The time limit is not for exiting. The time limit is for entering. Okay. The second question over here is, also, is the action of the AO entering in the business premise of B Limited at 8:30 p.m. valid? Now, even in case of B Limited, there is no survey, but in case of B Limited, there is a collection of information which is covered under 133B. Now, even in 133B, it is very clearly written that the AO can enter during the business hours. Now, the business hours of the SSC is 9:30 a.m. to 9:30 p.m. Therefore, the AO has absolute right to enter any time between this period. Okay. Therefore, he is entering at 8:30 p.m. It's all fine. It's absolutely fine. Therefore, in both the cases, the action of the assessing officer is valid in both the cases. Is it clear to all of you? I hope it is clear to all of you, right? Now, what is the question number 2? Is the action of the AO in impounding and retaining books of accounts and other documents of A Limited and B Limited after recording the reasons for doing so valid? So A Limited is impounding and retaining the books of, the AO is impounding. Impounding means taking the books into his custody of A Limited and B Limited after recording the reasons for doing so. Is it valid? Where he has not taken specific permission from Chief Commissioner. Now listen carefully. In case of survey, he is not supposed to take any specific permission. For survey, he has taken a permission, right? If he has taken a permission for survey, okay, there is no need to take special permission from the AO, from any higher authority, that is Chief Commissioner. Why there is no need to take any specific permission to impound books of accounts in case of survey? Because survey itself is a power, and within that power, within 133A, he has already taken an approval from higher authority to do survey. And if that is the power which is already given to him, there is no need to take separate approval from what? From the chief CIT or any other authority for what? For the purpose of impounding the books. Yes. But in case of B Limited, in whose case what is happening? In whose case collection of information is happening. So in that case, you do not have the power to collect what? Books of accounts. You only have the power to what? Collect information. Now if you want to collect information, along with that, if you want to collect books of accounts also, you want to impound books of accounts, you should obtain an approval from Chief Commissioner, which you have not taken, therefore you cannot do. Therefore, the action of the AO is valid in case of A Limited. Why? Because in survey, there is an inherent power to collect the books of accounts, to impound the books of accounts. But in case of 133B, there is no inherent power. You have to take an approval from the Chief Commissioner. Without that, you cannot impound the books. See, very clearly it is written in 133B. In 133B, you have the power to only collect information. You cannot take away anything else. You cannot even touch the books of accounts and other documents. For that, you have to take an approval, which you have not taken. Therefore, you does not have the right to impound books of accounts in case of collection of information without an approval. And therefore, the answer to this question is C. Third question. Let's talk about the third question. Now, this question is based on search and seizure. Pay attention, please. Can the AO issue notice under 148? What is the 148 notice? Notice to file ROI, return of income, to A Limited in August 2022. In respect of AY 1920, AY 2021, AY 2122. Now listen carefully. Generally, you can send notice within 3 years from the end of relevant AY. Now, for AY 1920, 3 years will end on 31st March 2023. Therefore, you can send the notice. Okay. For AY 2122, within 3 years, you can send till 2024. For AY 2122, you can send till 2025. So, you can send the notice for these 3 years, but you have to fulfill one condition. You have done survey, right? You have conducted survey, but you have to conduct one inquiry under 148A. That is mandatory. That you have to do. That is where you will give a show cause notice to assessee, then assessee will reply in 7 to 30 days, and then the AO will pass an order, and then AO will issue notice under 148. Therefore, you have to follow this due procedure, which is given in the law. Without that, you cannot do what? You cannot issue notice under 148. So, the question is, can he issue notice? Yes, he can issue notice, but before issuing the notice, he need to do an inquiry under 148A. Check, and therefore, the answer to this question is C. Yes, he can do so, but after following the compliances stipulated under 148A. He can do so, but he has to follow the inquiry notice. Okay. Now, the next question. The next question is what? Would the action of the AO entering in the premise of A Limited at 9 PM and impounding and retaining the books of accounts being valid if he has surveyed A Limited only for the purpose of verifying TDS, TCS in accordance with the provisions of the Act? Now, listen carefully. If an AO is entering the premise of the assessee for TDS or TCS, then there is a specific provision in the law which says that for TDS and TCS compliances, if you are entering, if you are doing survey for TDS and TCS compliances, then you have to enter after sunrise but before sunset. Then you cannot enter after sunset. That is not allowed. Therefore, the action of the AO is not valid. Because in case of TDS and TCS survey, it comes in any other case. If you are entering the business premises for checking the books of accounts, for checking the inventory, for these purposes, then you can enter even after the sunset, that is during the business hours. But if you are entering specifically for checking the compliances of TDS and TCS, you cannot enter after sunset. That is absolutely not allowed. And therefore, in this case, I have written the justification over here. For TDS, TCS compliance, enter after sunrise but before sunset. At 9 PM, obviously sunset has gone, sunset is completed, sun has already set. Now you cannot enter for compliance of TDS and TCS. For other purpose, you can definitely enter, but for TDS, TCS compliance, you cannot enter after sunset. Okay. Therefore, the answer to this question is B. Next question. Can the AO issue notice under 148 for bringing to tax income escaping assessment in case of C Limited without following the compliances under 148A? Now, what is the situation of C Limited? Let's see. Let's see what is the situation of C Limited here. Now, in July 2022, the business premise of C Limited was searched after following due procedures laid down under 132, consequent to which the AO has in possession certain documents and information pertaining to shares of 28 lakhs of AY 16-17 and shares of 21 lakhs purchased in AY 17-18. Now, for this year, that is 16-17 PY, AY is 17-18. The AO can issue notice up to 31st March 2021. The time has gone. Similarly, for PY 17-18, which is AY 18-19, the AO can issue notice up to 3 years. That is 31st March 2022. The time has gone. Now, the AO is wishing to issue the notice in July 22. The time has gone. The time has gone. For this year, the 3 years expired on 31st March 2021. For this year, 3 years expired on 31st March 2022, and the AO wants to issue in July 22. Not possible. Now, it would have been possible if the escaped income would have been 50 lakhs or more. Now, the escaped income, if I total it, 21 plus 28, it is around 49 lakhs. Therefore, that is also not possible. Notice, beyond 3 years, up to 10 years is possible if the escaped income is 50 lakhs or more. Here, that is also not possible. Therefore, in this case, the AO cannot issue notice. The AO cannot issue notice under 148, since the 3 years time limit from the end of the relevant AY has expired. Therefore, AO does not have the power. The next question is an extension of the previous question. Can AO issue notice under 148 for bringing to tax income escaping assessment in case of C Limited without following the compliances under 148A if the shares purchased in previous year 16-17 were 30 lakhs instead of 28 lakhs? Now listen carefully. If this is 30 lakhs, if instead of 28 lakhs, this is 30 lakhs. Okay, pay attention. If instead of 28 lakhs, this is 30 lakhs and this is 21 lakhs, then the overall amount will come to 51 lakhs. Now, because since this is greater than 50 lakh rupees, now the AO can issue notice under 148. And in this case, remember, in case of search and seizure, okay, you don't have to follow the due procedures under 148A. Not allowed, not required. It is deemed to be followed. Therefore, in this case, the AO can issue notice beyond 3 years because the aggregate income escaped is 50 lakhs or more. There is no need to take specific approval under what? Under 148A, not required. No, nothing is required. Only one specific approval has to be taken from the approved authority under 151. That is Chief Commissioner, Director General, Principal Chief Commissioner. There are certain authorities from whom you are supposed to take an approval. So, in this case, you take an approval from the authority mentioned under 151 and you can issue notice beyond 3 years. Why? Because the escaped income is 50 lakhs or more. And why am I not taking, why am I not following the due procedure under 148A? Because go and see 148A. In case of search and seizure, you don't have to follow 148A. There is no need to send us inquiry notice in case of search and seizure. Go and check it. Okay. So this is what this beautiful question is all about. Okay. Now let's go ahead with the next question. And this is also a very unorthodox kind of question. Generally a topic which is of one page itself, not more than a page. On that, ICI has made an entire case study of 10 marks. Let's see. The following are the details of Alpha Cooperative Society. There are 3 cooperative societies over here, Alpha, Beta and Gamma. Some of them are doing activities with respect to ATP. Some of them are not doing activities with respect to ATP. Okay. Now, what are we supposed to do? We are supposed to answer few MCQs based on them. Let's see one by one all of them. The first MCQ, question number 7. I expect you all to go through the question once at your end and then you come to me to listen the justification, which will be the utmost closest justification that an answer would ever require. I am not saying I will give you the best justification in the entire world, but I will give you the closest justification that is possible for any MCQ in this world. I'll try to do that, okay, with whatever little knowledge I have. Would Alpha and Gamma, okay, would Alpha and Gamma be entitled to deduction under ATP for AY 23-24 if they do not opt for what? 115 BAD. Now 115 BAD is a special tax regime for resident cooperative society. They are not opting for that. Now we need to say whether Alpha and Gamma are eligible for ATP. Let's see. Are they doing anything related to ATP? Yes, Alpha is doing credit facility to its members. Alpha is giving what? Credit facility to its members, that is covered in ATP. And Alpha also derives interest from another cooperative society. So remember, if a cooperative society give loan to another cooperative society, from there if it earns interest, then that is also covered in what? That is also covered in ATP. Therefore, Alpha is definitely covered in ATP. Is Gamma covered? Gamma is engaged in the business of banking and it is not a primary agricultural bank. It is not a primary cooperative agriculture and rural development bank. Therefore, it's a normal bank. Normal banks, normal cooperative banks are not covered in ATP. Therefore, Gamma is not eligible for ATP. Therefore, Alpha is eligible for 20 lakhs also and for 3 lakhs also. Why 20 lakhs? 20 lakhs is with respect to credit facility to members, that is covered in ATP. 3 lakh is with respect to interest from cooperative society, that is also covered in ATP. But Gamma is not covered in ATP. I hope it is clear to all of you. Second question. Would the provision of alternate minimum tax be attracted in the case of Alpha, Beta and Gamma if they do not opt for what? 115 BAD. Now they do not want to opt for 115 BAD. Because if they opt for 115 BAD, then to AMT is not applicable only. AMT is not applicable only. Because if a resident cooperative society opts for 115 BAD, then to AMT is never applicable. We are supposed to answer here. They don't want to opt for 115 BAD. They are going for the normal provisions. Will they be liable for AMT? Now AMT is applicable if a cooperative society is claiming any profit link deductions under ATIA, ATIB, etc. except ATP. An assessee who claims ATP is not liable for AMT. Not liable. ATP is outside the scope of 115 JC. AMT does not cover ATP deductions. So we need to find out. Second, an assessee who claims, first again I'll say, an assessee who claims any profit link deduction except ATP is liable for AMT. An assessee who claims 10 AA, an assessee who claims 35 AD. So we need to find out, is there any profit link deduction claimed by any of them? Yes. Alpha is not claiming any profit link deduction. Okay, so Alpha is not liable for AMT. Okay, Alpha is only claiming ATP and ATP is not subject to AMT. Beta is claiming ATJJAA. How ATJJAA? Beta is employing new members, new employees in the company, in the cooperative society. Check. And because Beta is employing new employees in the cooperative society, Beta is eligible for ATJJAA, and ATJJAA is a profit link deduction, and if you claim ATJJAA, you are liable for AMT. So Beta is liable for AMT. What about Gamma? Gamma is also not claiming any profit link deduction. Gamma is not even claiming ATP. Forget about other profit link deduction. Gamma is not claiming any profit link deduction. Therefore, Gamma is also not liable for what? AMT. Only Beta will be liable for AMT. Therefore, the AMT provision would be attracted only to Beta. Why not to Alpha? Because Alpha is not claiming any profit link deductions. Alpha is just claiming ATP. ATP is not liable for AMT. Why not Gamma? Gamma is not claiming any profit link deduction, including ATP. He is not claiming ATP also. So Gamma is also not liable for AMT. Only Beta is liable for AMT. I hope everyone is clear with this, right? Question number 9. Now, what is question number 9? Pay attention. What would be the tax liability of Beta if it opts for 115 BAD? So if Beta opts for 115 BAD, where is Beta? Beta is in between. Then what would be the tax liability of Beta? So if Beta opts for 115 BAD, listen carefully. Then if Beta opts for 115 BAD, listen carefully. Then AMT will not be liable for Beta. But at the same time, under 115 BAD, Beta will not be able to claim ATP also. ATP also not allowed. No chapter 6 allowed. If you go for 115 BAD, only ATJJAA will be allowed. ATJJAA will be allowed. Apart from that, no chapter 6 deductions will be allowed. So if you follow 115 BAD, listen, AMT is not applicable. While calculating the total income under 115 BAD, ATP will not be applicable because no chapter 6 is allowed except ATJJAA. ATJJAA will be allowed. So let's compute the income of Beta. Beta earns what? First of all, Beta earns 40 lakh rupees income from agriculture produce grown by its members. Okay. Then Beta also earned 12 lakh rupees interest on fixed deposits. Okay. So Beta has having a gross total income of 52 lakh rupees. You can check it over here. 40 plus what? Sorry, not this question. 40 plus 12, 52 lakhs. Now Beta is not going to get what? ATP. But Beta will get ATJJAA. How ATJJAA will be allowed? See, 8 employees are hired. 22,000 is the emolument. Up to 25,000 emolument, ATJJAA is allowed. 10 months they have hired. If they are hired for 240 days or more, they are allowed. Okay, they are hired for 10 months, so 10 months is more than 240 days. So deduction is 30% of that. So whatever is the amount, that is 5,28,000 will be allowed as deduction even if you follow 115 BAD. So 5,28,000, if you remove, you will get 46,72,000 rupees as your total income. On that, under 115 BAD, you are supposed to follow 22% tax, 10% surcharge, and 4% cess. Therefore, your tax will come to 1175, 850 round off. Okay, check it please. Is it clear? Now, next question is what? Pay attention. What would be the tax liability of beta if it does not offer 115 BAD? If it does not offer 115 BAD, we are supposed to do two calculations. Because if you are not following the alternative tax regime under 115 BAD, then you have to follow normal provision and AMT also, because beta is claiming 80 JJAA. Therefore, beta will be liable for normal as well as what? AMT. So, what will be the normal provision tax for beta? See, 40 lakhs is the income from what? That agriculture produce grown by its members. 12 lakhs is from where? See, 12 lakhs is from bank interest, Axis Bank and other bank, ICICI Bank. So, total 52 lakhs. Now, first of all, if the beta is not following 115 BAD, it is following normal provision, it will get 40 lakh rupees ATP deduction. It will also get 5,28,080 JJ. In normal provision, everything is allowed, right? Therefore, the total income will come to 6,72,000. Now, how will the tax be computed? So, while computing the normal provision, everything will be allowed. Take all income, take all deductions. Take ATP, take 80 JJAA, everything, the total income comes to 672. Now, what is the tax rate for a cooperative society? Up to 10,000, 10%, therefore 1,000. Above 10,000, up to 20,000, 20%, therefore 2,000. And above 20,000, how much income is there? 6,52,000, because total income is 6,72,000. So, 6,72,000 minus 20,000, we have already considered up to 20,000. So, balance 650 to 30%. So, if I apply that, I will get the answer as 206,540. That is the answer. Okay. Now, I have to compute AMT also. But if I compute AMT, the answer under AMT will come lesser only. Okay. Now, how much lesser AMT answer will come? Listen. How to compute AMT now? AMT is nothing but adjusted total income. How to compute adjusted total income? Total income plus profit link deduction. ATP will not be added back. Why? Because ATP is not subject to AMT. But 80 JJAA I have to add back. If I do that, I will get 12 lakh rupees as my adjusted total income. Apply 15% AMT, because for cooperative society, the AMT rate is 15%. In Hindi batch, I mistakenly said 18.5%, but that is wrong. That is 15%. Plus 12%, surcharge will not apply because the income is less than 1 crore rupees. Plus 4% cess. Now, if I apply 15% plus 4%, which will come to 15.6% on 12 lakhs, that will be far lower as compared to what I am getting in the normal provision. Therefore, my normal provision tax will be higher, my AMT tax will be lower, therefore, I have to pay tax as per normal provision. Are you clear? I hope it is clear. Okay. Now, one last question over here is, would it be beneficial for alpha, beta and gamma to opt for 115 BAD? Okay. Now, the question is, if I opt for 115 BAD, what is the disadvantage that I have to follow? The disadvantage that I have to follow, I have to miss out on ATP. Because if I opt for 115 BAD, you will not get ATP. So, it is not a wise decision to go away ATP, to let go away ATP for 115 BAD. ATP is a very big deduction. Therefore, I have to answer this question logically only. I cannot do computation for 2 marks, so much time I cannot waste only for get 2 marks. I am applying my logic and I am answering this question with logic. That if I go for 115 BAD, then I will not get ATP. I don't want to do this thing. Okay. So, would it be beneficial for alpha, beta and gamma to opt for 115 BAD? So, I would say go for 115 BAD if you are not eligible for ATP. If you are eligible for ATP, don't go for 115 BAD. You will lose ATP in that case. Therefore, we need to find out who is eligible for ATP. Is alpha eligible for ATP? Yes. Therefore, don't go for 115 BAD. Is beta eligible for ATP? Yes. Therefore, don't go for what? 115 BAD. Don't go. You will lose this deduction of 40 lakh rupees. Okay. Is gamma eligible for ATP? No. Gamma is not eligible for ATP. Therefore, for gamma, it is beneficial that you go for what? You go for 115 BAD. And that is my answer, which is coming out of logic. Check. It would be beneficial for gamma because gamma is not claiming ATP. But not for alpha and beta, because both of them are claiming ATP. So, therefore, ATP would be beneficial as compared to what? As compared to 115 BAD. Check it, please. So, now let's move on to the next question. The next question is again a very, very, very intelligent question. What is happening in this question? Pay attention, please, all of you. There is some dealer conference which is happening on 22nd and 23rd of August in Cochin to educate the dealers about the new product being launched by the company and how the product is better than the similar products of other companies available in the market. Now, in the dealer product, I am the dealer. You are the company. You are the company, I am the dealer. But my spouse is also coming with me. Okay. And the event is on 22nd and 23rd, but we are joining from 20th only. I am going from 20th only with my wife. Okay. Because it's a Saturday, I thought that let's enjoy, chill out for Saturday and Sunday. On Monday, we will attend the conference. The leisure trip was also organized for me and my wife on 20th and 21st August being the weekend. So on 21st and 20th, we were chilling out in a leisure trip. Maybe we are enjoying a cup of wine. Where? In a cruise. Okay. The expenses on airfare, hotel stay and leisure trip, all dealers and their spouse were met by ABC Limited. Now listen carefully. Now if the conference is on 22nd and 23rd, okay, the conference is on 22nd and 23rd, and if you are incurring some expenses, normal expenses, not leisure expenses on the dealer, then 194R is not applicable. But if the conference is on 22nd and 23rd, and if you are incurring some normal expenses on the wife, then 194R is applicable, because that is what perquisite. You have to deduct TDS. And even on the dealer on 22nd and 23rd, if you are incurring some expenses on leisure trip, that is also 194R applicable. So 194R is not applicable as per CBDT circular if on the date of conference you are incurring some normal expenses like travel expenses, food expenses on the dealer. 194R will not apply. But on wife, 194R will apply. On husband and wife, both leisure trip, 194R will apply. Similarly, one day prior to dealer conference and one day after the dealer conference will also be exempted. Okay, because generally it's a general perception that if the conference is on 22nd and 23rd, a person will come on 21st year and will go on 24th, because the conference might go on till late night on 23rd. So a person cannot leave on 23rd. He has to leave on 24th. So one day prior, one day after will also be covered outside the scope of 194R. You can enjoy the benefit of 194R exclusions. So now let's see what all benefits they have given. Let's see one by one. First of all, the first benefit which they have given is, pay attention. Pay attention. The first benefit, to and fro airfare of Mr. Ashok Sharma for New Delhi. Now that will not be covered in 194R because Ashok Sharma is the dealer and you are giving the airfare for the dealer. Second, you are also giving airfare for the wife of Ashok Sharma. This will be covered in 194R. This is not excluded. 194R perquisite benefit, deduct TDS. Okay. Then hotel stay including breakfast and dinner, 2 meals of Mrs. and Mr. Ashok on 20th and 21st. Expenditure was equal for each person each day. Now listen. Total you have incurred 30,000 for 2 days. Okay. Therefore 15,000 for 1 day. Okay. Now out of this 30,000, listen. Whatever you have incurred for wife, that is wife, spouse, that is entirely perquisite, right? And you have incurred 15,000 for husband. Out of that, whatever you have incurred on 21st, that will be allowed. On 21st, whatever you have incurred, on that 194R will not apply for husband. But for wife, what you have incurred on 21st, that will be covered. Because wife is not supposed to be accompanying you in your business trip. This is not Indian cricket team. Okay. I hope you understood. 22,500 rupees. How 22,500? For wife, entire 15,000 will be taxable. The wife portion will be entirely taxable, and the husband portion, which is a day prior to the day on which the conference was supposed to be starting. So conference was supposed to be starting on 20th, 22nd. You came on 20th. So 20th you will not get the benefit. 21st you will get, 1 day prior you will get the benefit. Therefore total will be 22,500 over here. Just make a count. 25,000 year taxable, 22,500 year taxable. Next. Hotel and stay including breakfast and dinner for husband and wife on 22nd and 23rd. This is the day of conference. Therefore here, listen carefully. On the day of conference, whatever you are entering, listen. For wife, nothing will be allowed. So therefore, husband will be allowed because husband is a dealer. So 50% taxable, 50% not taxable. Okay, the wife portion will be taxable. Is it clear? Next, leisure trip fully taxable. Leisure trip, there is no second thought. Leisure trip is taxable for husband also, wife also. You are not supposed to go to the dealer conference for a leisure trip. Okay. And then conference expenses on 22nd and 23rd attributable to Mr. Ashok Sharma. This is not taxable. Okay, because this is conference expense and that is attributable to the dealer. Therefore, what is covered over here is this 25,000, which is to and fro for wife, this 22,500, which is 15,000 for wife, and 7,500 for husband prior to the dealer conference, that is on 20th August. This 14,000 will be fully taxable. This 22,000 will be taxable. If you total it, it will come to 83,500 rupees. You can check it. Okay. Now, this entire question is based on what? Based on a CBDT circular, which we have done it in class in great detail. You can go and check it over there. Okay. Question number 13 talks about compute the specified income taxable at 30% under 115 BBI. Now, which all incomes are taxable under 115 BBI? Let's see one by one. There are around 5 to 6 incomes which are taxable under 115 BBI at flat 30% without any deduction of any expenses and allowances. The first thing that the trust has received is corpus donation. Now, listen carefully. If a trust receives a corpus donation, then it has to invest that corpus donation in the mode specified in 11.5, and if it invests in the mode specified in 11.5, corpus donation will be exempt. So let's see how much they have invested and how much they have not. So they have invested out of this 12,20,000, 2 lakh they have invested in post office saving bank account. Is it mentioned in 11.5? The answer is yes. So this will not be taxable. So out of 12,20,000, 2 lakh is invested in the deposit in post office saving bank account, so that is exempt. That is covered in 11.5. Fixed deposit with SBI, is it covered in 11.5? The answer is yes, therefore not taxable. Deposit with a cooperative land development bank, is it covered in 11.5? Yes, therefore this will not be taxable. Not taxable. For that you have to go through the mode specified in 11.5. Okay. Deposit with an NBFC engaged in retail car finance, is it covered in 115? Is it covered in 11.5? Not covered in 11.5, therefore this will be subject to tax. So in the first point, this will not be taxable. This will not be because these are covered in 11.5. The last one is not covered in 11.5. Therefore 4,10,000 will be taxable at 30%. Is it clear? I hope it is clear to all of you. Correct? Now listen carefully. The second point. The second point is based on specified persons which are mentioned in section 13.3. Do you remember that one of the specified person mentioned in section 13.3 is if the donor to the trust is a substantial contributor. What do I mean by substantial contributor? If the donor is giving a donation of more than 50,000 rupees in the entire financial year, he is a substantial contributor. And if you do anything for substantial contributor, that is wrong. And that will be subject to 115 BBI. So first of all, we need to find out who is a substantial contributor. Is Valish a substantial contributor? No. He is donating only 24,000. Is Ritesh a substantial contributor? No. He is donating only 48,000. Is Arjun a substantial contributor? Yes, because he is donating 96,000, which is more than 50,000 rupees. Now, if the trust incurs any expense for Mr. Arjun, that will be covered under 115 BBI. Trust is not allowed to do. That is wrong. That is not allowed. So, if you do anything in the favor of substantial contributor, which is covered in section 13 subsection 3, that is in the definition of specified person, you are gone. So, how much you have done for Arjun? 30,000. So, this 30,000 add 4,10,000 plus 30,000 will be covered in 115 BBI. Check. Are you clear? So, this is covered in specified person. A substantial contributor is a contributor who is contributing more than 50,000, and if the trust applied for such donors, then it is covered under 115 BBI. Okay. Third case. Income applied by trust for the benefit of Mr. Vaibhav Gupta, trustee, covered under 115 BBI, because you cannot, again, trustee is covered in specified person under section 13 subsection 3. You cannot do anything for the benefits of the trustee. Are you clear? That is also a violation of the law, and you will be taxable under 115 BBI. Next, you are incurring expenses. You are giving some interest-free loans for pursuing higher education. To whom? Income applied by trust for the benefit of Mr. Shamlar, Mr. Manohar Arora, Mr. Sridhar Agarwal, being the employee of the trust by way of interest-free loan. So, are employees of the trust covered in specified person? The answer is no. The employees of the trust are not covered in specified person. You can go and check the definition of specified person covered in section 13.3. Therefore, if that is not covered, you can give interest-free loan without any hesitation to the employees. And that will not be covered in what? 115 BBI. Okay. Next. Be very careful. Next one is a very intelligent point. Do you remember that generally we cannot do anything for specified person. A trust cannot do anything for specified person. That is a violation of law. But there are two exceptions to this rule. That if the trust is an educational institution or if the trust is a medical institution, then it can incur the expenses. It can give the facility to what? to the specified persons. Therefore, here the trust, suppose the value of educational services made available by trust to its education institution, made available by trust through its education institution to children of Mr. Vaibhav Gupta. Who is Mr. Vaibhav Gupta? Vaibhav Gupta, suppose I am Vaibhav Gupta, I am the trustee. Generally, trust cannot give any benefit to me or to my relatives, that is my children. Generally, trust cannot do all these things to me or to my relative, that is violation of law, that is covered in section 13 subsection 3. But the trust is an educational institution or it is a hospital, medical institution, then it is allowed to give the benefit to the trustee also and to the relatives of the trustee also. Then it is allowed. This is an exception in the law. Therefore, this will not be covered in what? This will not be covered in 115 BBI because that is allowed by the law. That is not considered as violation of the law. Therefore, this is not covered in 115 BBI. Be very careful. Next. Value of education services made available by trust to its education institution to children of Manohar and Sridhar. Who is Manohar and Sridhar? Manohar and Sridhar are employees. So the trust is giving some benefits to the employees' children. That is also not. If employee itself is not covered in the definition of specified person, then how come the employees' children will come under the definition of specified person? They are also not covered under the definition of specified person. Okay. Last but not least. Amount set apart in previous year 21-22, that is last year. Last year you have set apart some amount, that is you have accumulated some amount in the last year. Now it is your duty to use that amount within 5 years. Now if you don't use it, then it is deemed income and 115 BBI will apply. Now what are you doing in the current year? Last year you have accumulated some amount of 2,13,000 rupees and you are using that money in the current year to give donation. That is not allowed. You cannot withdraw the money from 11(2) modes and then you cannot use it for giving donation. It is not allowed. You have to use it for the purpose specified in the application at the time of giving the application to the AO in 21-22. In 21-22, while claiming exemption under 11 subsection 2, you would have given an application to the AO before filing the return. In that application, you would have written the purpose for which you want to accumulate, the period for which you want to accumulate. Now you cannot withdraw that money in the next year and give donation. If you do that, 115 BBI will apply. Now, if you total it all these things, that is 4,10,000, then 30,000, then this 25,200, then this 2,13,000 rupees. If you total it, the answer will come to 6,92,700 rupees, and that is your answer in this particular question. Check it, please. Okay. Now, the next question is based on the default in case of TDS. There are two defaults which you can do in TDS. The first one is, if you fail to deduct TDS, then what are the consequences that you have to bear? If you fail to deduct TDS, then you have to bear interest under section 201 subsection 1A at the rate of 1% per month. First consequence. Second consequence for failure to deduct TDS is penalty under 271C. Okay. These are the two consequences that you have to bear for failure to deduct TDS. What is the consequence that I have to bear to failure to pay TDS if you don't remit the TDS on time? In that case, the first consequence is again interest under 201(1)(a) but 1.5% now, 1.5%. And the second consequence is not penalty. 271C is not applicable for late payment. It is only applicable for late deduction. There is a very recent Supreme Court judgment also. That 271C only talks about late deduction. It does not talk about late payment. So if you do late payment, then what is the second consequence? There can be prosecution launched against you under section 276B check. So for late payment, for late deduction, there is an interest and penalty. And for late payment, there is again an interest and prosecution, no penalty. Okay, check it please. I hope it is clear to all of you, right? And one last question, which is also very intelligent question over here. Let's try to understand this question very clearly. This question also has a concept of dividend stripping. So first of all, I would like to explain you the concept of dividend stripping, what exactly dividend stripping is all about. So what is dividend stripping? Suppose this is the record date, that is the date on which the company is declaring dividend. Now, if within 3 months prior to this date, if you have purchased some shares or some units, okay, so this is the record date, say 1st June 2022 is the record date, and within 3 months before this date, that is June has gone, May, April and March, you can say March, April, May. In the last 3 months, if you have purchased shares or units, and if you sell these shares within 3 months and units within 9 months. So for purchasing both, the time limit is 3 months, but for selling shares, it is 3 months. For selling units, it is 9 months. Now, suppose in the last 3 months, you have purchased the shares or units for 100 rupees. Now, if you have received some dividend of rupees 10 rupees, now more importantly, that dividend is exempt. Now, if you sell these shares within 3 months or units within 9 months, then if there is some loss attributable to you, suppose there is a loss of 15 rupees here. How? Suppose if I sell these shares for 85 rupees, there will be a loss of 15 rupees. How? 85 is the sale consideration, cost is 100, therefore 15 rupees is the loss. So much of the loss as is attributable to the exempt dividend will not be allowed to be set off. So you have to make two bifurcation of this loss, that is of 15 rupees, you have to make two bifurcation. To the extent it is attributable to exempt dividend, that much loss will not be allowed to set off, this 5 rupees will be allowed. So the provision is very simple, that you have bought shares or units in the last 3 months, then you got some exempt dividend, and after declaration of dividend, generally the prices of the shares fall. Okay. So because the prices of the shares are falling, you are selling the shares, you are booking a loss, and you are setting off that loss against other incomes, other capital gains, and you are also enjoying the exemptions of dividend. Okay. So we will not allow you to set off that much loss to the extent of exempt dividend. That much we will lapse it. Okay. Now, this is the first concept which is covered in this particular case study. The second thing which is covered in this case study is the concept of REIT, Real Estate Investment Trust. There are 3 REITs over here in which you have made an investment. Ganga REIT, Yamuna REIT and Indus REIT, and from all the REITs you are receiving some dividends. Now, when is the dividend exempt in the hands of the investor and when it is taxable? Now that depends. If the SPV, listen carefully, if the SPV is following 115BAA, then it is taxable in the hands of the investor. But if the SPV is not following 115BAA, then it is exempt in the hands of investor. So first of all, we need to find out when it is taxable, when it is exempt. So SPV opts for 115BAA, therefore it is taxable. SPV does not opt, therefore it is exempt. Okay. And if it is taxable, you have to deduct TDS at the rate of 10%. Okay. TDS is deductible at the rate of 10%. So because the SPV is not opting for 115BAA, the dividend is taxable. If SPV is opting for 115BAA, dividend is taxable, and if it is taxable, TDS will be deducted at 10% with respect to the Ganga REIT. What about with respect to Yamuna REIT and Indus REIT? Listen. In case of Yamuna REIT, this 35,000 rupees. Now listen carefully. There is one more information which they have given. Also, would the dividend stripping provision of 94(7) be attracted if Mr. X sells the units in all the 3 REITs? Now, in case of Ganga, dividend stripping will not apply. Why, sir? Because dividend is not exempt. For dividend stripping to apply, dividend should exempt first of all, right? In Yamuna also, dividend stripping will not apply. Why, sir? Because the dividend, the units were purchased 5 months prior to the date of record date. Check. The record date is June 22 and you have purchased the units in Jan 22. Dividend stripping is applicable only if you purchase 3 months prior to the record date. So here also dividend stripping is not applicable. Is dividend stripping applicable here? Yes. Dividend stripping is applicable here. Why? Because you are purchasing the units in last 3 months. On the record date you are getting exempt dividend. And then you are selling within 9 months. Check. From the date of record date. From June to January, it is within 9 months. Therefore, dividend stripping is applicable here. Therefore, the answer to this question is Ganga REIT is required to deduct TDS. Why? Because here it is taxable. Okay. Whereas Yamuna REIT and Indus REIT are not required to deduct. Why? Because here it is exempt. Dividend is exempt. No TDS. Okay. And as far as dividend stripping is considered, dividend stripping is only applicable in case of Indus REIT. In case of Ganga and Yamuna, dividend stripping is not applicable. In case of Indus, it is applicable because in case of Indus, we are fulfilling all the conditions mentioned in 94 subsection 7 of dividend stripping. So this is what this beautiful RTP is all about. This is one of the most beautiful, and I can say it is one of the trickiest RTP that ICI has made. All the questions were very intelligently framed. None of them were very straightforward questions. Okay, so I hope you all enjoyed the video. I hope you all have understood everything what I said in English. I don't know I speak good English or not, but I hope I have tried to convey the message whatever I had to give you in English with respect to this RTP. If you enjoyed it, please do comment below your experience of learning direct tax from me. Do share this video with all your friends so that maximum students of South India can take the advantage of this, because there are very few videos in English. There are a plethora of videos which you will find in Hindi, but there are very few videos which you will find in English which will helping the CA final direct tax students in the southern part of this country. So take care all of you. God bless you all. I'll come up with more videos like this for MTPs also, and also many other things which is possible from my side as early as possible. Take care all of you. Bye.